And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story, real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to the show. Of course, it's the Hump Day edition as it is Wednesday, as we are also facing down Fed Day today. The meeting, of course, started yesterday. The big question today is, will they cut rates by 50 basis points, 25 basis points? What's going to be the outcome of this? And more importantly, how will the markets react? And this is going to be one of this will be the driver for the markets today. And again, not surprising. Over the last month, markets have been rallying pretty strongly into this whole rate cut issue coming up. And interestingly enough, the market, in terms of the bets that they're making on rate cuts, has surged to over the open interest contract for Fed rate cuts being 50 basis points today is now over 800,000 contracts. It is a huge surge in the contracts placed on a 50 basis point cut today. So, one of the risks that potentially faces the markets today is disappointment. If the Fed comes out and only cuts 25 basis points, that's going to be very disappointing because there's the market's betting on 50, right, by all stretch. And the other question becomes is, if they do cut 50, is it buy the rumor, sell the news? This is going to be one of the other issues. I don't know how this day is going to end up. A lot of people are expecting they're going to cut 50 basis points today and this market's going to take off to the moon. Maybe that's the case. But again, everybody's kind of betting on this. As Sam Stovall once said from S&P, is like, if everybody's bought, who's left to buy? And everybody has bought the 50 basis point cut today. So now, interestingly enough, retail sales came in yesterday a little bit better than expected. Retail sales are continuing to weaken overall, right? But still stronger than expected. That increase in retail sales, which is 40% of personal consumption expenditures, right, which makes up 70% of GDP, pushed the Atlanta Fed GDP analysis to a 3% growth rate for the third quarter. So now you've got employment is still kicking along. Yes, it's weakening a bit, but employment's still kicking along, 140,000 jobs a month or so. Unemployment rate is still just around 4%, certainly not high by any stretch of the imagination. And you've now got economic growth at 3%. There's really nothing here suggesting that you should be cutting rates by 50 basis points today, much less even really cutting rates. Interestingly enough, this is the thing to think about. The Fed should be cutting rates to offset real economic weakness, real concern here, but there's not a real, push of economic weakness coming across the board. Yes, it is weakening, right, but it's still relatively strong to where we were. And it certainly suggests that the Fed needs to be a little bit cautious here about cutting rates. And the reason is, again, if economic growth is at 3%, inflation should be around 3%. So that's higher than the 2% growth rate that the Fed wants. So yes, inflation is coming down, but if the economy starts picking up traction, that's going to start lifting interest rates. That will start to lift inflation a bit here. Now again, we're not talking about inflation going off to the moon, but if economic growth is at 3%, then inflation and interest rates should be around 3% as well. That's higher than what the Fed wants. So now the Fed's going to kind of fuel that fire a bit by cutting rates. And if you cut rates by 50 basis points, that really kind of sends a different message, to the markets. Now, look, there's certainly some concerns out there, and maybe the Fed is looking at some issues that, are outside kind of the mainstream numbers. Maybe they're seeing some credit stress. One of the interesting things that have been put out lately is there's a massive credit wall, maturity wall that's coming next year for corporations. A lot of the small and mid-cap companies have a huge amount of debt coming due next year. And if interest rates are still elevated, by the time we get to that point, they can't refinance a lot of that debt. So this is, there's the financial crisis issue out there that maybe the Fed's looking at. There are certainly concerns in the markets that would warrant a rate cut, easing back on some of that monetary tightness. We'll see. And again, but the markets are heavily betting on a 50 basis point cut today. So I think one of the bigger risk here is that markets are so optimistic about the rate cut that this turns into a kind of buy the rumor, sell the news kind of situation. But again, we'll see how this works out today. I really don't have a great feel for how the markets are gonna operate today, so we'll just have to kind of navigate our way through it. But let's take a look at a couple of different markets because it is interesting right now. So this is the S&P 500, one we look at every day. On a buy signal, not extremely overbought yet, and flirting with all-time highs right now. So again, markets closed yesterday. We're sitting right at all-time highs. Nice triple top that's getting built right now. So kind of make or break for the S&P. The S&P either needs to break out to all-time highs, or we're going to kind of form a pretty significant level of resistance if the market fails later on today, following the Fed rate cut. We'll see what happens. But interestingly enough, while the S&P is doing this, the NASDAQ, which is more heavily tech-weighted, obviously, is not performing nearly as well. So you have kind of a very nice wedge pattern that is now building within the NASDAQ and still well below kind of previous highs. And this is, kind of the thing that you want to be paying attention to here. So we've got the S&P at nearly all-time highs. The NASDAQ's not, but it's getting ready to start making a move. If it can break out to the upside today, the mega cap stock should start getting a bid here if we can kind of break out of this consolidation. But that kind of shows you that the rest of the market's been playing a bit of catch up here. And we see that, obviously if we start looking at the S&P 500 equal weight, which is the equal weighted index, it's actually been making an all-time high. Now look, relative performance basis, the equal weight index is still way behind the S&P, but you are seeing much better performance here of the market. So, we talked about this real narrow breadth earlier this year. It was only the Mag 7 really driving market returns. That's certainly changed here as of late, but all these markets, the S&P, the NASDAQ, and specifically the equal weight index is now very overbought here. And again, this is because of utilities and real estate and all those kind of defensive sectors that all of a sudden everybody kind of woke up and said, oh, look, let's buy some utilities because, of AI. Utilities have had a huge run here just since July. You've had a very big run in utilities. They're extremely overbought, extremely stretched. Real estate is the same way. We've had a big rotation, again, expectations of Fed rate cuts, lower interest rates, had a huge surge in real estate. So all of a sudden, and we've talked about this before, this is the one thing about investing to always remember, is that when everybody hates something, that's generally something that you want to start looking at for an investment. Earlier this year, everybody hated utilities. Everybody hated real estate. Nobody wanted that. Now, people can't get enough of it. This is the real estate chase for AI. It's the utility chase for AI. Natural gas is kind of been the new chase. So, again, now everybody is in these trades. So now you got to start thinking about where is everybody going to go to next. And just remember that markets do rotate. What's in favor for a while is going to come out of favor at some point. Just remember that. Don't forget, and again, we're kind of in this position that we're about to start rebalancing our portfolio on this side. We're going to wait till after the, kind of what happens today with the Fed, but probably Thursday or Friday, we'll rebalance our utilities and our real estate and things like that in our portfolio because they've just had huge gains in just a very short period of time. So again, and these are just extremely overbought. And like for instance, real estate's about to trigger a sell signal from a very elevated level. So again, you're going to get a rotation at some point. So importantly, don't forget to take profits, rebalance your risk, manage expectations. I have no idea how today's going to turn out, so you may want to hedge that a little bit. Ahead of that, if you've got a lot of real heavy equity exposure, maybe trim that back just a bit, going into the meeting. Again, not massively, just maybe take some profits, rebalance here. And if the Fed does cut 50 and the market rallies, great, you're still in. But there is a risk, like I said, of that kind of disappointment that could lead to a bit of downside in the market here short term if they don't cut by 50 basis points, and maybe even if they do. That's what you need to know before the bell this morning. When we come back from break, we'll pick up with Danny Ratliff. We'll talk a little about the Fed rate decision, what that means for your portfolio, of course. And we got a lot of other topics to get into today as well. So stick around, don't go away, be right back.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. Danny Ratliff joining me as well. So talk a little bit about, kind of the Fed rate cut today. That's going to be the big decision. And again, this is the big challenge right now. As I said, if you really kind of take a look at recent economic data, it's not terrible. Again, certainly weakening on a lot of different fronts, and certainly can't argue that. But again, we still have positive job growth. Unemployment rate still just around 4%. As I said, and inflation's coming down. So there certainly doesn't seem to be a emergency risk on the horizon that would suggest the Fed would cut rates by 50 basis points. But again, the markets are very heavily betting on that. And so maybe the markets know something I don't, which is usual. But, this is, it's going to be interesting to see what happens today. But again, there's, we have a lot of indicators that also suggest that, we do have a recession on the horizon. Jeff Gundlach was just talking about recently, of course, he's the CEO of Double Line Investment, the big bond firm. And he wrote an article that was published on Think Advisor talking about 6 signs that a recession is near or here. And if that's the case, and if that happens to be what the Fed's looking at, then that's why they're going to cut rate 50 basis points in order to try to offset that recession. But again, we've had inverted yield curves. We've had, leading economic indicators have been negative for a very, very long period of time. And we haven't had a recession yet. And again, that doesn't mean you won't get one. I'm not saying that at all. But, the markets are certainly at that juncture to where they're looking at the trail and going, we've had this data for a very long time and we haven't had a recession yet. The economy's still kicking along, earnings are still growing. What's this going to be? But Danny, this is kind of one of the issues that's the big challenge right now with the markets is, recession, no recession. Why is the Fed cutting rates 50? Where do we go to from here?
Well, are they truly going to cut rates by 50? Right now the odds are 65% it's a 50 basis point cut, 35% that it's a quarter. But like you mentioned, economic data isn't terrible.
Right.
It's not great. It is slowing down, and that is what it should be expected. And that was the whole intent of keeping these, rates higher for longer. And so this is where it becomes problematic and a challenge as far as, understanding, duration risk, understanding what to do with markets, because markets have been in an environment where good news was bad news. Now some days or some weeks it's the opposite. Good news is just that, it's good news. And this is where I think the struggle comes, because the Fed, I'm not sure, they have a difficult task ahead. I mean, there's no doubt. And we're going to be able to Monday morning quarterback this like nobody's business. But, we're not going to know the full impact and if they were right or wrong for some time. What I think is the challenge, Jeffrey Gundlach hit on a couple of different things, things we've talked about, yield curve uninverting, consumer confidence changes where, we've kind of seen that teeter back and forth. Retail sales numbers, they were fairly promising. So looking at that, the consumer has to feel better. But, I always trace that back to where the fund's coming from. Wage growth has declined. At some point, liquidity you would think would dry up, but we've been thinking this for a long time. And so clearly this can go on much longer than we anticipate. You think about unemployment. Now those numbers and the task that that's been put in front of them has been, they want to manage unemployment, keep it around 4%. They want to get, like you mentioned a bit ago, inflation down to 2%, but is inflation stuck at 3%? Mm-hmm. Is that where we are? I mean, we've known that this is going to be stickier than what we've anticipated, that, that change, the delta between where we were and where we are today was significant. We were coming down from 11.9, but now when we got to 5, getting from 5 to 3 has been a challenge. 3 to 2 may be even a larger challenge here moving forward. And so, the unemployment trends are troubling as well. And Jeffrey Gundlach, he mentions that in here. I'll put that in the chat. So if anybody's on YouTube, you guys can check it out in the chat box. And then manufacturing labor weakness. We've continued to see that. What ISM manufacturing for New York comes out shortly, right? Mm-hmm. Philadelphia Fed, we'll get numbers from them. Obviously there's a big talk about the federal budget, the deficit, what we have going on here. He mentions that as well. But Lance, he's been mentioning this for how long?
I don't know, long time.
A long time. And so a lot of the things that we've historically seen have changed because of the type of economic environment that we're in. And, we've talked about the challenges coming out of COVID, the supply chain disruptions, all the other things that have continuously, we continue to hear about and understand and know, and then the response on the other end of that. So the economic environment prior to raising rates was much different than what we've historically looked at. And the same right now. And so can we actually bet on that there's a 50 basis point cut? What if they do 25? I see a lot of you guys in the chat are talking about it's 25, and you guys may be right. And I think that, nobody exactly knows. And interesting, I was listening to a podcast this morning based on numbers, and they did a survey on a bunch of economists, and most private economists believe that it's a 25 basis point cut.
Well, no, look, like I said earlier, the Fed runs a risk of cutting 50 basis points, which is kind of alarming people that maybe there's a lot more weakness in the market than kind of what we expected, right? And it's like, like we're talking about, it's like things are slowing down for sure, but what do you know? What are you so worried about that you're cutting 50 basis points? But Brent, can you bring this chart up for me real quick? But this is the leveraged bets on Fed rate cuts. And right now we have the largest, as I said earlier, there is more than 800,000 open contracts out on a 50 basis point cut right now. It's the largest on record that we've seen on taking leverage bets on Fed's futures. So, this is, so the market, Danny, the market is betting on 50 basis points. Economists are saying 25. It seems like almost no way you come out of this today. If I'm Jerome Powell, there's almost no way to come out of this today without disappointing somebody.
Well, but think back to the beginning of this year in January. The market thought we were going to have 6 rate cuts. Mm-hmm. And then it went to 1. Then it went to 0 by the time we got to April, May. And all of a sudden we get to August and everybody's thinking, oh, we're going to have 3 to 4.
Yeah.
There's only 3 more Fed meetings.
Yeah, including today.
Yeah, correct.
September, November, December.
So if you're going to have 4, they're suggesting there's going to be an emergency cut at some point along the way. You want to talk about spooking the markets. Mm-hmm. That's one way to do it. Now, you mentioned the other day that you could potentially see, what if you see the 50 basis point cut and they say, look, we're going to wait and see. I think they run the challenge of not doing enough quick enough, and that may be what they're worried about. Okay, inflation's coming down. We're seeing other numbers that are deteriorating a bit or being revised downward. maybe they try to get out ahead of it and say, hey, we're going to play the wait and see approach. You got to think there's some political forces at hand here as well. Somebody's tapping them on the shoulder and saying, hey, we've got an election coming up. Let's say you got an incumbent president, but that doesn't seem to matter. But historically, you would have them saying, do what you can to spark the economy right now. And who knows what Trump's going to do? Trump wanted to fire Powell way back in the day. I mean, you remember back in 2018 when he said, hey, we're a long ways from neutral. In October, market peeled off 10%. He comes back in November and says, whoa, we're done. It was the worst fourth quarter we've seen since the Great Depression, 20% decline. In a year where tax receipts were, booming, right? We had the Tax Cuts and Jobs Act that just was just put into place, and the economy was humming pretty well. So, you've got to think there's going to be some political plays here at hand. And maybe they're going to try to say, we do the 50 basis point cut now. We wait and see. And that way it doesn't look like they're manipulating things just prior to the election.
I agree. I don't know.
I don't know either.
Yeah. I mean, it's all a guess. And this is what I'm saying is like, trying to do anything in your portfolio today ahead of this meeting is really just, totally a guess. Because I really have no feel for how today's going to turn out. I mean, we could finish the day up 1.5% or today down 2%. So, I mean, it's anything is possible. So again, we'll have to just kind of wait and see how this turns out this afternoon. But again, it's just, Danny, as we just kind of talk about these things, it's important to just kind of keep all this in perspective, is that we do have weakening economic growth. I posted out a chart this morning. Let's see if I can find it here real quick before we hit the break. Yeah, here it is. Just in the last month, while we are having this economic data that's coming out, and Atlanta Fed's going, okay, GDP is going to be 3% growth, and everything is fine, and the Fed's going to cut 50 basis points. That light blue line, the one that looks like a double mountain on the right-hand side, that's earnings estimates for the S&P 500. They have absolutely collapsed in the last month. So now this is sentiment, right? So if what happens on Wall Street is that earnings estimates are ratcheted up, and then people chase stocks higher because of higher earnings estimates. And as we get close to earnings season, which is happening right now, we're going to start earnings season the next couple of weeks, those estimates collapse. So all these companies can beat estimates as we start reporting. So again, we're seeing that normality of what's going on with Wall Street right now, is that the earnings estimates are now collapsing for 2024. This will allow more companies to beat estimates as we get into earnings. But again, why are earnings estimates coming down? That's the question, right? And the reality is that economic growth isn't nearly as strong as what Wall Street is saying economic growth and earnings are supposed to be. But earnings have to come from economic growth. So keep a watch on that. Optimism. Optimism across the board right now is just extremely high with everybody, which often is something to pay attention to. All right, quick break. We'll come back. 3 Vanguard funds to own ahead of the Fed rate cut. So if you are looking for a fund to buy, Danny's got 3 choices for you when we come back from the break. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Oh, Red, I declare, I plumb missed that candy coffee. Whatever am I gonna do?
Don't you worry, little darling. We'll watch it again on our YouTube channel.
Why, Red, I never.
The Real Investment Show YouTube channel has all of our past presentations, from Candid Coffee and Lunch and Learn to special topic discussions, and all of our live show recordings preserved for you. Subscribe now to the Real Investment Show YouTube channel, or look for the link on our website at realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
Today is a very sad day because we had a very serious set of deaths in our house.
The Real Investment Show podcast.
It's been just a very traumatic few days. We lost our new coffee maker, we lost our air fryer, and we lost our oven when this power surge came through the house.
Same show, your schedule.
That's how big the surge was coming through the house, but I've not had coffee for 2 days, so just beware. I don't know what you're going to get this morning on the show, but
at realinvestmentadvice.com.
I'm a little cranky.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning. At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. Realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access, like Technically Speaking Tuesday, Financial Fitness Friday, plus each day's radio shows. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So I was digging around my closet this morning trying to find my pager, but couldn't find one. Who has pagers these days?
I heard there may have been some U.S. senators and representatives that may have got caught up in this.
No, just like who still has a pager?
Well,
how do you make them explode? That's what I wanted. How do you make a pager blow up?
I don't know. I looked into this a little bit yesterday. Evidently,
Okay.
they put like 2 ounces of some, some type of powder, obviously, that it heats up so they can heat those batteries up, which will make them all explode.
Right.
I don't know. I briefly dug into it for a minute. I was like, this is...
Well, like I said, first of all,
Interesting.
somebody's got to manufacture these, put the explosive in them, and then sell them to people.
Well, but they evidently, the Mossad intercepted it from Taiwan, and then, they took the shipment.
Oh, okay.
They,
Got
tinkered with it a little bit and sent it on its way. Man, that's, but, I think they went to pagers, I was reading, because they actually blew somebody up through their cell phone just prior to this.
Oh, jeez. Okay.
So, man, the things that these guys can do is,
But
yeah.
fortunately, I couldn't find my pager, so I just wanted to check it, make sure it was okay. But
Yeah, I mean, what, I don't know. I guess if you're trying to be discreet and not get on, normal lines,
can be
things that can be
traced.
tapped,
I mean, you can't trace a pager, so I guess.
I'm sure you can.
I'm sure you can.
You can blow one up from wherever in the world. I'm pretty sure you can trace a pager.
Probably true. Probably true. It's above my pay grade.
Yeah.
So I had a couple people asking for Mrs. Roberts' stories this morning. I don't have any. She's been working all week in meetings with Carnival Cruise Lines and a couple other things, and she was at a soccer game until 11 o'clock last night. All I will tell you is that this woman is extremely cranky right now because she's tired. And so I'm just leaving her alone. I'm not picking on her. I'm just minding my own business for it's personal safety reasons right now. So yeah, no stories for you this morning.
Well, that's a good one. I mean, everybody knows. I mean, who wears the pants?
Yeah, so she does for sure. Yeah, I have my little space. She relegates me to, and that's where I stay.
Yeah, I tried to intervene yesterday morning with the kids, and I was shown my way out pretty quickly. I said, all right, fair enough. It's your show.
So Fed's going to cut rates today. Vanguard's, got an article out talking about 3 funds to own ahead of the rate cut. But of course, earlier this year, they were saying the Fed wasn't going to cut rates, and now they might cut rates. And now there's funds to own before the rate cuts. And so I don't know.
Yeah, this is everybody's challenge. It's Vanguard didn't write this article. This is a Barron's article. And this is something that we're getting a ton of questions on. But I actually was pulling it up a bit ago in a different, internet provider. And, one of the things that came up was don't count on the Fed to cut rates this year, Vanguard says, as of July 30th. So this just goes back to show that this has been so a moving target and will continue to be. And so I think placing large bets is difficult. Right now, Lance, Mike have been talking about for some time that, yields have gotten overdone pretty quickly. We should expect maybe quite a bit of a small pop here that may be a better entry point. But, a common question that I know we're receiving here is, what do we do with cash? Where do we go? And, how do we start to put funds aside to capture these yields while they're here? And inevitably, because Feds are going to cut rates today, it looks like, we're seeing a whole lot of headlines about that. And so they did have some interesting things and takes on Vanguard funds. And I may not even pick on the Vanguard funds, but give some other ideas in the sense of what you could be looking at or what you should do. And, there's a lot of different things, but it varies person to person. I visited with a couple yesterday on the East Coast, and they, were looking for options, but they didn't want to tie the funds up for a long period of time. Mm-hmm. And they may not have wanted to take some interest rate risk in the event that rates don't fall as much as they think, or they creep back up a bit. So for somebody like that, maybe a position like BIL, a really short duration, and keep in mind, this is no recommendation. Everybody is different. These are just things that we see and that we're talking about and that, we're getting a lot of questions on. So BIL, a short duration, 1 to 3 year treasury ETF, may be something that you can utilize for a time being, but as interest rates fall on that short end of the curve, we should expect that to fall with it. Here internally, we did just this week, SHY, 1 to 3 year, just for cash, trying to get out ahead of it. But that's more of a placeholder in the sense that if we believe rates are going to drop, but they're overdone and we see a tick up, I mean, what happens, Lance, if we don't cut 50? Market thinks we cut 50. They only cut 25. Do you see yields pop?
Well, yeah, look, there's something that's going to happen. All I know is for certain, there are certain dynamics that you're not going to fight, right? And that's technicals. There are certain things that are going to occur simply from a function of how markets work on a supply-demand basis. And, right now, bond yields are very, very overbought, so you're going to get a correction. And at some point, so in other words, yields are going to pop back up here at some point. And what causes it could be, disappointment, could be a bad auction, could be a super hot, economic number comes in, next employment number is 300,000 for some reason. And that sparks some concerns about a return of inflation, and yields are going to pop up. And again, it's everything. It's, gold on a monthly basis has only been this overbought. As a good example, everybody's been chasing gold ahead of the Fed rate cut because gold tends to perform better when rates are getting cut. But on a monthly basis, gold has not been, there's only been 2 other points in history going back the last 40, 45 years where gold has been this overbought on a monthly basis. And following that overbought condition, it suffered a long correction. Now, again, just kind of went nowhere for a very long time, several years. So, again, there's just certain dynamics you need to be paying attention to, and there's a lot of bets being placed on rate cuts that have now gotten extremely extended, and at some point, something will happen and will cause those to start to reverse. And I just don't know what that event's going to be.
Well, I mean, yields on the 10-year up 5 basis points in the last 2 days. So that's kind of a decent indicator. Yeah. But so you need to think about when do you need these funds, right? You can look at CDs, brokered CDs, finding ways to lock yields in. If it's short term, looking at something like an ETF that maybe you can get in and out of rather quickly if you needed to. But understand there could be a bit of volatility. Those really short ones we don't expect much volatility. So keep in mind, one thing we look at, obviously credit risk. We currently like treasuries more than we like corporates. The spread's not extremely large. Now, there are some times we can, find some one-offs that look attractive. But, you also are looking at the duration. And so what's the measure of sensitivity to interest rate changes? So if you don't know what duration is, essentially, if a duration is, let's say it's 6, and yields drop by 1%, you should expect a 6% increase in the net asset value of that position. Now, if yields go up by 1%, you should expect to see a drop of 6% of that net asset value. So it's an inverse relationship. So if you are going to make a longer term bet, and here's the difficult thing, I think, and Lance, you may correct me, I think if we're in this environment, we're going to get lower. The Fed at the moment, I think the target is, 3% Fed funds rate? We're at 5.25 to 5.5 right now. That's a pretty decent drop. That's by the end of 2025. That number will change. But if you bought today, or if you bought in a month, you may have a bit of buyer's remorse. But I think if you look in a year, you're probably either way, you're going to be in a pretty good spot. Does that make sense?
No, it does. But I mean, look, we were buying treasuries back when nobody wanted them, and everybody was like, why are you buying treasuries here? Interest rates are going to the moon. It's like, well, no, they're not, because of inflation and economic growth. And that's, the thing is that, yeah, you may buy them today and you may suffer some buyer's remorse, but in the near term, and then you Danny's right, as the economy slows down, as, we kind of go through this cycle, you should do well with bonds. But the issue is just, as is always the case, is timing, and it's always trying to buy stuff that nobody wants. Again, we were buying utilities and real estate earlier this year when everybody hated them, and we got a lot of grief for it, and now everybody wants them. So, so the goal is trying to buy stuff that not everybody wants right now. And so when you look at your portfolio, if everybody's trying to buy something, that's a great time to start thinking about taking some profits and rebalance. Doesn't mean sell everything. It just means, rebalance some risk, especially when things are extremely extended, extremely overbought. Take some profits and go buy some stuff that nobody wants and everybody hates, because that's probably going to be where money moves to next.
And remember, though, there's some of those investments that everybody hates for a very good reason. So do your homework.
Well, yeah, of course. Yeah, if the company's going bankrupt, nobody wants it for a reason.
Well, I mean, you look at a lot of these, who knows, because those have been the ones that people are going after, right? Look at Bed Bath & Beyond, look at GameStop, all these companies that have been propped up for an extended period of time. And really, you could probably argue by short sellers for the most part.
Yeah, well, it's short sellers and meme traders.
Yeah, and then everybody, things happen. Everybody has to go long quickly, and it changes the game, rather quick. But so what I'd encourage you to do is understand, get a really good understanding as far as your need for funds and what you're looking to do. I wouldn't encourage you to put all in one or the other, but, just like you would maybe ladder CDs or bonds, you can do so with ETFs. You can do so with individual positions, and get a really good understanding as far as what your goal is. Is it for capital appreciation here? Our thoughts are that there's probably a window of time that we're going to be able to take advantage of. If the Fed and the government in general goes with the old playbook that they've used over the last 5 to 10 years of stimulus, then I think we could expect that even if we get into a slower time or a recession and they come out and dump a lot of stimulus money on the economy, we could argue we're going to see inflation again. So you need to understand, if you're buying those longer duration bonds, you're likely not going to hold those until maturity. So, these are common questions and themes that you're seeing. Lance, how many questions do you get on fixed income a day?
Yeah.
You don't even know.
Too many.
Yeah.
But there's the thing that people need to understand, though, is that if you're long bonds, that's great. Like Danny says, you're not going to hold them to maturity. The trick is going to be figuring out where the terminal rate is for interest rates. In other words, where is the bottom in the decline in interest rates? A lot of people are expecting is, if they go back to 0.5%, well, that's not going to happen if you're not in a recession. If it only goes back to a normal economic growth, it could be 2.5 or 3, and that might be a whole lot closer to where we are, which means upside is limited in bonds. So figuring out where that terminal rate is going to be very important. All right, we'll come back, wrap up the show. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So one of the big things that's going to be happening, of course, depending on the outcome of the upcoming election, is tax policy. And right now you got both candidates running around talking about different tax policies of different sorts. So, for instance, President Donald Trump came out and said he wanted to cut taxes on tips, and then the Harris campaign picked that up. Since then, he's come out and said, hey, I want to cut taxes on, other issues. Just recently, he wants to bring back the SALT tax deduction, which is state and local tax deduction. So in other words, if you're in the state of Texas, as an example, and you pay a 8.25% sales tax, that will be tax deductible on your federal taxes. And that makes some sense. Again, when you start talking about taxation, you look at, the tax rate is 33% or 28% or whatever your personal tax rate is. But when you actually look at all the taxes you pay roughly about 50 to 55% of your income goes out in taxes of some sort, whether it's, gas taxes or city taxes, state taxes, consumption taxes through, things like when you pay your cable bill, right? If you ever read your cable bill, like your cable cost is like $12 and then there's like $300 worth of taxes and fees right on top of it. So,
or your electric bill, your water bill, it's ridiculous.
But you pay a lot more in tax than you realize. So tax policy is very important, obviously, because tax policy is inflationary. And we talked a little bit about this the other day, which is that, for instance, Donald Trump wants to cut corporate taxes. Kamala Harris wants to raise corporate taxes. Well, taxes get passed. As we said yesterday, corporations are tax collectors. They're not taxpayers, because even though they wind up writing the check for the taxes, they're passing that tax on to the consumers, either through higher prices or lower wages, whatever it is. But they're basically offsetting that tax as you go along. So the key to tax policy is to create a tax structure that creates better economic activity. and gets people to save and invest and spend because that's what drives economic growth. And so a good tax policy, whatever it is, and this is why there's been, Danny, debates for flat taxes and consumption taxes and a whole variety, simplify the tax code and by, moving, to a simpler form of taxation is better because, again, the goal is to get people to spend money in the economy, but again, the more you extract from them in taxes, the less they have to spend. So it's almost a circular fight. I need to raise taxes so I can collect more taxes so I can spend more government dollars and not run a deficit. But at the same time, you need people to be spending money so you have economic growth, right? But you're taking more money from them in taxes. So it's almost a circular fight when it comes to taxes.
Well, it is because then they're spending money in, unfruitful manners.
Right.
And so that's the challenge that they're faced with as well, is that, they want to keep their things going. And this is where the problem with politics in general, and I hate to get too far down the rabbit hole on this, but when we elect them based on what they're doing for their constituents in their area. So Lance, Brent, you're both in different sides of the country, and we're going to say, well, great, we need to do some austerity. We need to start making some cuts. Mm-hmm. We're going to trim the budget. Who's raising their hand? Because you got to go back to your people and say, hey, I had to let this go. And they're going to say, well, shoot, we're not voting for you. We're going to get this other guy in here. So that's one of the bigger problems. And we're not doing what they're set to do. The government should do really two things, infrastructure and defense.
Right. Well, that's under the Constitution. That's
correct.
All the government's supposed to do.
Yeah. But now they've gotten in the business of doing so much more. And I can argue, we work with plenty of different people, that they are way better stewards of capital than the government, unfortunately. Mm-hmm. And so, you look back, and so Trump made a point, actually, was talking about, well, when we reduced taxes, tax receipts went through the roof. Now, some of that was repatriation of funds because he allowed people to bring stuff back from overseas. But a lot of that was just spurring economic activity. And we keep hearing, oh, well, there's going to be means testing at some point. Everything's means tested already. Look at the grid from a tax perspective on the tax brackets. How much money we have, VAT tax overseas. Guess what? You have that here too. Mm-hmm. It's based on how the sales tax, the amount of money you spend. So all these things are already there. Medicare premium surcharges, Social Security taxation. And I don't know that it's ever going to get any better because of the environment that we're in, of the government spending money the way that they are. So regardless of which side of the aisle you sit on, at some point you've got to think, if they cannot stop spending money the way they do, we're going to have a problem, and taxes will have to go up at some point. Yeah. So this is great. We've talked about, it's a lot of political rhetoric. It's likely just that. Getting these things done would be, I think, and some of them would be great. Some of them would be terrible. Mm. The SALT tax, it's kind of funny because Trump eliminated that in the Tax Cuts and Jobs Act of 2017, but now he's going to bring it back. And I think that, he probably sees from a voter perspective that impacted a lot of people on the East Coast, like Northeast and the West. Right. And so getting after that base, I think is, it's smart on his part, but is it something they can, number one, actually do? Number two, is it something they even want to do? Yeah.
Well, like, eliminating tax on tips. That's 2% of the population that works for tips. I mean, these are small little, but look, those get votes, right? You're gonna, I'm a waiter or a waitress, or I do. Of course, now everywhere I go, somebody's wanting a tip. But
oh man, it's like, hold on, wait a second, I'm buying a stick of gum. Exactly. What do you mean?
Especially when you go to self-service and then they're asking for a tip when you check out after servicing yourself.
Well, it drives me nuts. Some of those won't even allow you to, there's okay. And now they've gotten really ambitious where some are like 25%.
Oh, yeah.
It's like, wait.
Yeah, no, they used to be like 10, 15, 20. Now I'm seeing it as 15, 20, 22, 25. Yeah, they've all been creeping up as well. But the point is that's a very small percentage of the population that work on tips. But what does impact a lot of people is their personal income tax rate and then corporate taxes, which again get passed through to consumers. So these are decisions that they sound great on the surface. We're gonna make the rich pay their fair share, right? This is tax the rich. But the rich, the top 50% of income earners, we talked about this the other day, pay 97% of all the taxes. The top 20% pay about 70% of all the taxes. So, exactly how much are we going to tax people until they simply just don't have anything left to tax?
Well, but people have to understand as well that most of these people, while we're all under the same tax code, and everybody gets so frustrated because they're not paying their fair share.
Well, what is the fair share? That's the question.
Well, that's right. And if you think about it, what you just mentioned with the top 1% paying the majority of it, top 20 paying quite a bit, 50% don't even pay taxes.
Mm-hmm. They actually get money back.
So where's your fair share?
Yeah.
If this is, never mind. I'm not even going to get into it.
Well, no, but this is the one thing that nobody ever explains is we need the rich to pay more in taxes. Okay, great. That's fine. I don't have a problem with that. They don't have a problem paying more in taxes. Just make it equal and equitable across the board, right? You want me to pay more, everybody needs to pay some more. But the problem is that when you go after the rich, the problem is that money is portable. And you got to remember the wealthy are the ones that create most of the jobs because they're your business owners. So again, when you tax them more, and this is what we talked about a couple of weeks ago, the original tax was 3%. It was a 3% tax on the wealthy. That was the original income tax. And everybody's like, well, it's just, so tax the rich goes all the way back to the beginning of taxation, by the way. We're going to put a 3% tax on the wealthy. That's where we're going to get our tax revenue from. And then here we are 180 years later, and everybody's getting taxed now, right? So taxes never stay at the top. They wind up working their way through. Either the government's going to tax you, or the companies and the wealthy that you're trying to tax are going to pass that cost through. So you're either going to pay it in higher price. So at the end of the day, the consumer winds up paying all the taxes, right? They either pay it through, higher prices, or they pay it through higher taxes. And that's just the way it's always worked. And this is why the tax code, which is this monstrosity of a thing, needs to be reworked at some point to simplify it. Because again, the only way to fix the problem of taxation, you got to get rid of all the loopholes, right? There's just so many loopholes. And this is why General Electric and Amazon, they have whole teams of accountants that are simply working on maximizing the tax code to their benefit.
Which I would argue anybody would do if you had the means and resources to do it.
Absolutely. That's why that's why you should have a good tax accountant. If you have money, you should have a good tax accountant. They'll save you more than you pay them.
Yeah. Now, so you increase the taxes on the rich. What happens, right? Wage growth declines even more. Mm-hmm. We've already got a credit problem at the moment. And you're going to see investments, like you said, being portable. They're going to take their business to other places. So, we're looking to repatriate, workers and get manufacturing back here. That doesn't happen under something like that, right? Because they're going to say, well, why would I do this here if I can do it overseas for pennies on the dollar, and I'm going to be taxed X amount more here? And then you're going to have unions come in and say, well, we need our fair share as well. So they need to be paid X amount. And so this doesn't solve the problem.
No, it doesn't. And it's like, somebody in our chat said, well, why don't we just put a yearly tax on people with over $50 million? That's great. They'll just take if you've got $50 million, A, you own a company.
Well,
most likely. And B, that money is portable, and they'll take their $50 million and go somewhere else.
Well, but so here's the problem with that, right? So now you're talking about that unrealized capital gains, essentially what Harris has campaigned on, which number one, I believe is unconstitutional. Number two, you want to talk about people moving and forced liquidations. You want to talk about deflation because who's going to buy that asset? Because we know plenty of people with closely held businesses, family businesses, things that they created from nothing, land that's been bought that is appreciated. And now if you say I'm going to have to pay my taxes on that each year, even though I've not liquidated anything, who's going to buy it? Number one, no one, except government and big corporations. So now you're perpetuating a bigger issue and a much larger problem. You're taking free enterprise and capitalism out of the market.
That's right. Sorry, got off on a rant.
Yeah, don't get me going.
So, Fed rate cut today. Back tomorrow with Michael Leibowitz. Be sure and like the channel. Hit that like button. We very much appreciate it. It certainly helps our analytics with Google. Helps push the stream out to more people. We appreciate your help with that. Be back tomorrow with Michael Leibowitz. Talk about what the Fed does today, what that decision means, and of course, we'll talk about what the market responded to tomorrow. See you then. Have a great day.